October has been a difficult month for markets, with equities falling 7% from their mid-September highs, leaving them up only 1.2% year-to-date in local currency terms, but still up 7% year-to-date in euro terms, given the weaker euro. Recent weakness has been due to concerns over slower economic growth, mainly emanating from Europe, while ongoing geopolitical concerns and the spread of Ebola have also added to investor anxiety, contributing to a substantial pickup in volatility levels. Given this backdrop, core global bond yields have fallen, with German 10-year yields reaching new all-time lows of 0.71%, while peripheral spreads have widened as Greece negotiates the next phase of its bailout programme. While economic releases have been softer recently, leading indicators suggest growth will remain positive and improve into year-end. One of the most widely followed leading indicators of growth are the Composite Purchasing Managers Indices, which are shown in the chart, and which remain consistent with strong growth being maintained. PMIs are monthly surveys of global corporates where companies comment on the outlook for their business in coming months, and are constructed so that a reading above 50 indicates economic expansion and below 50 indicates economic contraction. The blue line in the chart relates to the global economy, and at 54.9 is close to its highest level in 3 years, consistent with growth of over 3% in the global economy. While the red line representing the Eurozone has rolled over, at 52 it is still in expansionary territory and suggests growth in the Eurozone economy of around 1.5% over the next year. Some of the recent concerns over European and global growth resulted from a very weak industrial production figure in Germany, which fell -4% month-on-month in August. Much of this, however, was due to retooling and holiday-related shutdowns in the auto sector, with production in the German auto industry down 25% month-on-month in August. September German auto production figures have already been released and showed a rebound of 40% month-on-month, which should result in a strong rebound in both German and Eurozone industrial production in September. Global industrial production has also been weaker through the summer owing to the impact of the April sales tax rise in Japan, uncertainty in Europe relating to Ukraine, and disruptions in Brazil during the hosting of the World Cup. Strong retail sales data, however, suggests global industrial production should soon rebound. The blue line in the top chart is the inverse of global inflation plotted against global retail sales, and shows retail sales tend to rise as inflation falls. Through August, global retail sales are growing 4.8% annualised. Regionally, retail sales are growing 1.2% month-on-month in Eurozone, 1.9% month-on-month in Japan, and 0.4% month-on-month in the UK. The current low levels of global inflation suggest retail sales will remain strong in coming months. The second chart plots global retail sales, the blue line, against global industrial production, the orange line, and in recent months there has been a disconnect between the two. The low levels of industrial production growth at the time of strong retail sales suggest inventory levels have been run down and that global industrial production will rebound in coming months. One of the first releases of September industrial production came in the US last week and was up 1% month-on-month. The labour market remains strong in the US, with initial weekly unemployment claims falling to the lowest level in 14 years, while unemployment has fallen to 5.9% and non-farm payrolls have risen 224,000 per month on average over the last 3 months. While September retail sales fell -0.3% month-on-month, core US retail sales rose 3.8% annualised in Q3. These suggest growth remains robust in the US. Corporate and consumer confidence levels also remain strong. The blue line in the top chart shows the number of US corporates looking to increase hiring, while the red line shows the number of corporates planning to increase capex in coming months. And both have been on rising trends and are close to 6-year highs, highlighting corporates' increasing confidence in the US and global economic outlook. The second chart looks at consumer confidence, with the red line being the UK, the blue line the US, and the green line the Eurozone. Consumption accounts for approximately 2/3 of most global economies, and with consumer confidence close to 9-year highs in the UK and close to 6-year highs in both the US and Eurozone, despite rolling over slightly, the outlook for global consumption remains positive. With leading indicators suggesting global growth is set to remain positive and rebound in coming months, we believe recent weaker data indicate the global economy is currently experiencing a mid-cycle soft patch as opposed to a more severe slowdown. While recent weakness in equity markets has been mainly due to concerns over the global growth outlook, we believe these fears are overdone and economic momentum will improve again in coming months. The current weakness in economic data appears to be a mid-cycle soft patch, as has occurred in previous cycles, and should prove to be temporary. Global central banks have suggested interest rate rises might be delayed, and market expectations for the timing of the first rate rises have been pushed out, which should also be supportive of equity markets. While the recent increased volatility is likely to remain a feature in markets, we believe equity markets will rebound again as economic data improves in coming weeks and months.